Says preparing to live stream. We are live. Mr. Turkington.
Good afternoon. How are we doing today?
Dude, we're doing awesome. How are you?
I am so excited about this conversation. I can't wait.
Oh, come on. This is fun stuff.
I know. That's what I said. I didn't say I dread this. I said I'm excited about it.
All right. First off, thanks everybody for just joining the group in the first place, but we've had just a ton of reach outs in the last week, just trying to keep up with everybody, make sure we're getting back to everybody that we said we were going to get back to. So thank you, everybody. Good afternoon, Ashley. Thanks for tuning in. So Ken, what's your take on this here over the last week and a half since we launched the group? Tell everybody what you're thinking. Sorry, I'm darting all over. I got a couple screens going.
I have been amazed at the interaction, the responsiveness of people, the interest in not just mortgage conversation, but just the whole, maybe interest in the whole financial space, meaning, hey, what does that mean to me? What aspects should I be considering? And people being open to those conversations has been far, far greater than what I was expecting. So like you said earlier, thank you.
That's awesome.
Yeah, it's cool.
All right. So mortgage stuff is boring. So we try to typically stay away from that. But let's get into the stuff that I don't think it's boring. So it's always fascinated me. When we look at a mortgage, there's three main components. We have the credit component, the income component, and the asset component. Today, we want to focus a little bit on that credit component to help all of you out there that are watching, not only in your personal situation, if you're a real estate agent or a builder's agent to help clients, or you're helping your friend, family, coworker. I do want to say, everybody watching, invite your friends, family, coworkers, anybody you think that's going to get value from our group. Hit the invite button, bring them on in so they can see the next time we go live. And hopefully we can help a few of you out there today. So the title of this is 760 credit scores forever. Why is that? Why that number, Ken? Why are we sticking at 760?
That's the threshold that says you're in the A+ category from the mortgage side of things. So our credit reports, a 760 credit score gets you the best interest rates. It allows you to qualify for the cheapest PMI if you're not putting the full 20% down. So that's the mark that says you are now A+.
You're a stud. All right. Lowest cost of borrowing funds out there available if you are 760 plus. So this is something that we want everybody to have. And we know that there are circumstances that happen, events that happen in people's lives that can change those scores. As we go through, so I can't even remember how many leads we had last month, but this month we're trending somewhere around 600-700 leads, where we'll speak to 300-400 people this month. And as we're working through the mortgage qualification process, the credit component is the number one component that stalls or delays the transaction from happening in, say, 30 or 45 days, and it pushes it out to 3, 6, 9, 12 months. Talk to me a little bit about that, and how you're handling that as it's coming up, and give me your feedback there.
Yes, what we find is people have a good sensitivity level to what their score is, because there's tools out there that allow you to see what your score is on a consistent basis. Now that's a little bit different than the mortgage scores, but once we get into that credit discussion, we have, you know what? I forgot that I co-signed for one of my kids' cars. We had some increased expenses this last month and my utilization is high. So, there's a number of factors that we can address or need to address, either to get the debt levels down, which correlates to a higher credit score. But there's been a ton of those conversations where it's not holy cow, there's nothing that can be done, but there is a little bit of an action step or two to get where we need to be.
Pretty
And those
much every
action
time.
steps. Yeah.
So I asked you yesterday, when you're looking at that report, what's the first thing you go look at? And you said to me, credit scores. Obviously it's towards the top, but it gives you an overall.
I like this to start at the top. It's easier for me to follow.
I'm already cheating and skipping steps, and I'm getting right to the good stuff, which is typically what?
That's the amount of debt.
The credit card debt, right?
Yep.
Fascinating to know. What are you carrying? How much? How long have you had it? How long are you carrying these balances for? What cards are you using? And then we get to that big component, which is what is that weighted cost? What's that interest rate blended of all those cards that you're carrying balances on? What does that look like? And
we've got a worksheet for that, but it's easy for people to go, hey, it's $3,000 here, or it's $7,000 here. I'm going to work on that, and be oblivious to the fact that it's 18 to 24% interest that's accumulating on those. And that's what that worksheet is designed to do. It's like, hey, let's just spell it out. So, because information is power, right? There may be an idea that says, hey, take your blended cost and I got this. This is going to be gone in a certain period of time. Great. But then for a lot of folks, they go, oh my God, I cannot believe that interest rate is that high. I'd like to reconfigure how I'm viewing that debt, because that's just ridiculous.
As we're having that conversation, just the fact that we're bringing that up in the call, you can smell, the, what do they call that?
The wheels grinding.
The wheels are just burning up there. You can smell it. And they're like, oh my God, I have this Old Navy card with $2,500 on it. Well, that's at 26%. That's a big deal. We've got to find a way to take care of that, move that out of the equation in terms of what life is going to look like for you as you become debt free. So
that awareness is the key, right? Meaning going through that is just an ability to look at it, because we can get so numb to our daily routine, and a month or 6 can go by like that. I didn't even realize that. That's been the part that's been fun with the conversations of, hey, just let's look at this. Like, I'm on it.
Yeah. Go look at yourself in the mirror right now. Are you carrying credit card balances month over month? A lot of you are going to answer yes. Those are you specifically, you folks watching that are answering yes. We want you to reach out to us. We're going to help you with that so you can visualize it and see it on paper, what it actually looks like. And then, like Ken said, we put some action steps in place. Credit inquiries. That was fascinating to you. As you're pulling up the credit report and they said they want to buy a house, you're going right to that, which is at the very bottom of the report. What's that telling you?
That just gives me an idea of how active somebody has been. If there's something else that we need to address, right? So if somebody's interested in buying a home, we'll see if we're not the first person they talk to, a mortgage company inquiry. But I'm also interested in what's been going on with cars, what's been going on with credit cards, what activity or what may be top of mind for these people that we don't see in just the transaction details above.
There's no way around. Before you close on your mortgage, what happens again?
Yeah, so the lenders, 3 to 7 days before closing, they're going to do a soft check to find out what new accounts, if any, and if there's been any inquiries, so that they know, all right, did you sneak in another debt right before closing? We just have to make sure that
did you juice that credit card to do something?
What's going on?
Totally. All right, you had mentioned some of the other. So we do a ton of soft credit pull here. pulls here. This is where we start. We'll do a soft credit pull just to get you started. When you actually go to get your formal pre-approval or lock your interest rate, that will turn into a hard credit pull. We have folks that will come to us and say, you know, Kirk, I'm 780, I'm 760, I'm 740. And I'll ask them, is that from Credit Karma? And most of the time, yes. What do we know about us versus the real scores versus Credit Karma?
Yeah, there is a difference. So I believe that's a consumer credit model. We have the actual mortgage report. Ours is more detailed, pulls in more information. Generally, it is more it's more harsh on the score than what Credit Karma is. So our scores typically come in lower than what Credit Karma shows.
About 20 points.
That's a fair
on
number.
average, give or take. So if you tell me you're 720 or 740, I'm in my mind knocking 20 points off before we actually get the report. Okay, so when we say credit is the number one hiccup, it isn't necessarily the scores, it isn't necessarily the amount of debt, it isn't necessarily the monthly payments of all the debt. Credit, liabilities, and income kind of match together in terms of your debt to income ratios, but credit is where we spend most of the time guiding you and advising you and making sure that you're sticking to the plan that we identify in order for you to make things happen. You guys watching out there right now, and you want to learn more about your particular scores or your particular action steps that you need to take, just send us a message, PM me or private message Ken, and we'll get right back to you.
Yeah, we've had that a couple of times, just to your point, Kirk, where we have, hey, you need to increase your borrowing ability or your credit account in order to help your score. And you get people, they shake their head, but that's the stuff that we talk about, right? That it's not the same path for every person. But those are the things that we like to help with and give some encouragement to say, this is the great path for you to take to get to that 760 and hang out there for a long time.
Absolutely, forever. Credit utilization, secured credit cards, attacking the higher interest rate cards, just some small examples to throw out there to you guys to start thinking about. Let us help you go through that though. Soft credit pull, we'll take care of that for you on our end. This is just to get you, I suggest you do that once a year. Do at least a soft credit pull once a year in case anything flows on there from the past. Could be a medical collection or gosh knows, could be an error altogether that you want to make sure that you're attacking and it doesn't pop up or
good point.
block you.
I'm Ken Turkington III, so that there was always something that would pop onto my report. Wasn't derogatory, but there was always something that I would have to address from my dad that like, hey, where did this come from? And so it's maintenance, right? Just like anything else, you want to stay on top of it.
Guys, thanks for tuning in. We will be back once a week. We'll let you know when we're going live. Keep providing some value. Share this link or invite some people to our group. The more people we can help, the better. And we'll talk to you guys soon.
Take care, guys.